Hello, everybody, and thank you for tuning in to our paper. My name is Jared Finnegan, and this is joint work with Jonas Meckling. And the title of the project is Corporate Governance, Time Horizons, and Climate Policy Preferences. Now, we're just at the beginning stages of this work. Indeed, this is the first time we've presented it. So really looking forward to your thoughts and comments. The starting point for the paper is the fact that many policy challenges require that governments make intertemporal trade-offs. So this basically just means that governments have to impose some costs on society today in order to generate greater future benefits. And we can think, and there are a number of examples of this. So we can think of infrastructure policy or certain types of social policy, and of course, climate policy. Now, we think that this intertemporal trade-off also happens at the firm level. So long-term policies impose costs now on business, but they can also generate future gains for business, future profits for business. And so we think that understanding how firms confront intertemporal trade-offs can help us understand their political behavior. And just to give a sort of an example of this, we can think about the case of carbon pricing. And so here, when a carbon price is adopted, carbon-intensive firms bear some cost today, which reduces their short-term profits. But these firms can also make long-term investments today, which can generate greater future value or greater future profits. For example, energy efficiency upgrades to lower future production costs. They can innovate to develop new low carbon products and services to capture new markets, for example. They can also totally restructure their business and move it in a new direction, a low carbon direction. So at the firm level, then, the intertemporal trade-off, we think, is between present profits and future profits. And this is what confronts the managers of companies. So the question then is, what shapes the temporal preferences of firms? How, in terms of, so how do they deal with this trade-off? And there's a large literature in comparative political economy, but more importantly in business studies and in management studies that shows that firms' ownership structure shapes the time preferences of managers. And there are two basic types of owners that are identified: patient owners and impatient owners. So patient owners are investors that won't exit the firm, so dump the stock, remove their investment, if managers don't respond very quickly to short-term fluctuations in financial markets or product markets, or if managers focus on long-term rather than short-term gains. And so when a firm is owned primarily by patient owners, we think that they should be more insulated then from the myopic pressures of investors or of capital markets. Now, the opposite situation is when a firm is owned by impatient investors. Now, these investors will exit the firm very quickly or dump their stock if managers fail to hit quarterly earnings expectations or quarterly profit expectations. So what this then does is it can decrease the stock price of the company, which can reduce the remuneration that the managers receive. Oftentimes, executive pay is tied to the stock price. This increases the probability that the manager can be dismissed and also opens up the firm for a hostile takeover. So all of these things create strong incentives then for managers to hit short-term earnings expectations and not upset impatient owners. And indeed, there's some work on this in business studies. There's a sort of a well-known survey that points out or finds that 78% of US corporate managers admit to sacrificing some long-term value to hit quarterly earnings targets. So we think that then when firms are owned by impatient investors, they're less insulated from myopic pressures. So that's the kind of business sort of studies literature that we're bringing in, and then we're also trying to theorize the political implications of this. So bringing in the politics. What does this mean for politics, especially climate politics? And what we think is that when firms are owned by impatient investors, managers face pressures to focus myopically on quarterly earnings. I've already just discussed that. We think then that should make them less willing to make intertemporal trade-offs to comply with stringent climate policy and or make long-term investments towards decarbonization. Because again, these investments require some reduction in short-term profits for greater long-term gain, and managers won't be willing to do this when impatient investors are pushing them to maximize short-term profits. So what this then means is that in managers' political preferences should be tilted against long-term policies like climate policy. And the basic schematic is this. So ownership structure shapes corporate time preferences, which then shape firm-level political preferences. So we have a few hypotheses that are observable implications of these arguments. So the first is between publicly traded companies and privately owned companies. And we know, again, from a lot of work in business studies that compared to privately owned firms, publicly traded companies tend to be less shielded from short-term pressures of capital markets. Indeed, they're traded on capital markets, and it's very easy to buy and sell their stock. So the first hypothesis is that public companies should be more opposed to climate policy than private ones, all else being equal. And now amongst publicly traded firms, we think that patience will vary because ownership structure varies. There are many different types of owners, and each of those owners has a different sort of patience profile. Here is one sort of take on a continuum from less patient owners to more patient owners, and this is adapted from some work by Deegan Hardy. This is our thinking to date. It's not sort of set in stone, but this is how we're also conceptualizing patient versus impatient owners. So again, we think, and I'll go into more detail about these in the empirical section, but for right now, the point is that we should expect that because patience varies across different owners, we should then expect that to inform firms' climate policy preferences differently. So amongst just publicly traded firms, we think that those with higher ownership by impatient investors should be more opposed to climate policy, and then those with higher ownership by patient investors should be less opposed to climate policy. So moving into the empirics. So we test these arguments looking at US firms. So there are a lot of firms in the US, which means we can get quite a large sample size. There are a lot of different firms across different sizes, as well as there's a lot of variation on the independent variable. So there's a lot of variation in terms of ownership structure. And so we decide first to look just at US firms. Now, for the dependent variable, we need some measure of firm-level climate policy preferences, which is not an easy thing to come up with. We've spent a lot of time trying to figure out the best way to measure this. At the moment, we're borrowing data from a recent paper by Jared Corey, Michael Lerner, and Ian Osgood that some of you may be familiar with, came out in AJPS last year. And they code firm-level membership in ad hoc coalitions that are opposed to climate change and that lobby in opposition to climate policy in the US. And what we then do is take that data and generate a dummy variable. So a firm gets a 1 if it's joined one of these opposition groups, and a 0 if it's never joined an opposition group. And about 90% of the firms that have joined any opposition groups join 1. And so we think using a dummy variable is sort of justified. Here is just an example. Actually, these are all the opposition groups that Corey et al. Come up with, and so it just gives you some examples of what we're describing, the kind of coalitions, ad hoc coalitions we're thinking about and coding. On the independent variable side, we first want to code and measure whether firms are publicly traded or not. And so for that, it's quite a simple thing to do. We just extract that data from Orbis. And then amongst publicly traded companies, we want detailed ownership data. And so we collect that from S&P Capital IQ. And we collect data for a set of inpatient owners and a set of patient owners. And these are the ones we think should be sort of the most likely inpatient owners and the most likely patient ones. So on the inpatient side, we're measuring investment manager ownership. So this is management, or this is ownership by mutual fund managers in particular. Now we're collapsing both active and passively managed funds into this category. In the next step, we want to divide those, but for right now, this is all sort of managed funds. Um, and then the second group, the second inpatient owners are investment banks. There's a lot of evidence that because investment banks want to get high returns for their clients, they put a lot of pressure on managers. They have short-term profit expectations, so the stock price keeps rising. Now, on the patient owner side, we measure the percent of ownership by foundations and cultural endowments. The idea here is that these types of owners will have a much longer time horizon, and won't be so quick to dump a company's stock if it runs into some, or if it doesn't hit sort of, again, quarterly profit expectations. And then we also code pension funds as patient, again, because there's some evidence that pension funds as well are long-term oriented owners and tend to hold stock over the long term. So we have a sample of politically active firms, and we need a comparison group for that. And so we collect a stratified random sample of non-politically active firms to compare against. And at this step, we're just using the same, or at this stage in the project, we're just using the same sample, again, from the Corey et al. Work. So it's about 55,000 firms, and it's 25% are drawn from small, medium, large, and very large categories. Now, we include a number of controls, and the first is to control for the cost of climate policy. So a lot of the work, and the main focus of work in terms of climate politics and business has been about how the cost of climate policy shapes the preferences of business. And we don't, we see our work as complementing that. We don't disagree with that at all, but we want to make sure we're controlling for the cost that policy is imposing on firms. And so we control for carbon intensity of firms. And we use, again, we borrow this data from the Corey et al. Study. We also control for firm size. That could have an effect on whether firms are likely or have the sort of the resources to lobby. And then we control for company headquarters. Most firms, 90% of the sample are US firms, but there are some that are headquartered outside the US, so we control for that. And then very importantly, we control for cross-sectoral variation. We have all sectors represented in the sample, and sectors are quite different, and so we want to control for those sector level differences. And so you can think about the results as comparing firms within the same sector to one another. So moving right along into the results. So first, looking at publicly traded versus privately owned firms. What we see is strong evidence that publicly traded companies oppose climate policy more than privately held ones. And that's in line with the expectations. And then we look at, amongst publicly traded companies, firms with patient owners versus inpatient owners. And we see, again, strong evidence that firms with inpatient owners oppose climate policy more. So both in terms of investment, when investment managers have a higher stake, they oppose more, and when investment banks have a higher stake in the firm opposes climate policy more. In terms of patient owners, the results aren't as clear. And so what we see is the coefficients, the signs of the coefficients running in the right direction. And so we see less opposition from firms that are, when ownership, when cultural and educational foundations own more of the firm, and when pension funds own more of the firm, they oppose less. But the coefficients aren't estimated very precisely. So we don't have statistical significance. These results are a bit sensitive, so it depends on how you do the controls and the sector level fixed effects. But in this specification, again, we don't see very strong evidence that patient owners that firms with patient owners are opposing less. Okay, now the next step for us is testing the mechanism. So how do we know that it's time horizons that are driving these results and not some other causal channels? We want to make sure, again, our argument really hinges that this isn't that this is really about intertemporal trade-offs and manager time horizons. So we test this in two steps. So the first, we test whether corporate time preferences predict political preferences. And then we test whether ownership structure predicts time preferences. Now, to measure time preferences is not straightforward. But what we do, at least at this stage in the process, is we rely on work that's already been done in business and management. And we use an index or a technique for developing an index that was first put forward by Kappas and Schmidt in 2013. And what it is essentially taking 9 variables that are publicly available, financial data, and grouping them into 3 long-term categories, and then creating an index based on these variables. I don't have time to go into exactly how we do it. I guess there won't be Q&A, but in the draft of the paper, you can see sort of more information on how exactly we construct it. But the point is that the index runs from 0 to 1. And it should provide a comprehensive measure of firms' long-term orientation. So we first look at, again, whether firms with longer time horizons oppose climate policy less, and we find strong evidence of that, which again is in line with our expectations. So again, when firms have a longer-term orientation, have a higher score on the long-term index, they oppose climate policy less. Now, the next step again is to show that ownership structure shapes time horizons. And what we see is strong evidence that firms with impatient owners have shorter time horizons. But we don't have clear evidence, again, that patient owners encourage or that firms with patient owners have longer time horizons. In the case of educational cultural endowments and foundation ownership, we see some evidence in Model 2 that is sort of goes in line with our expectations, that these firms have, again, a longer time horizon. The case of pension funds, the sign is running in the opposite direction to what we'd expect. We don't see statistical significance. So again, we're still trying to make sense of these results. Now, moving in to the implications of this work, before I wrap up, we think that ownership structure is a major unexplored source of businesses' climate policy preferences. Indeed, a recent example of this is the engine number 1 ExxonMobil case, where a hedge fund with a long time horizon was able to change ExxonMobil's board to make it more friendly towards decarbonization. We think also that the rise of passive investing may be a new source of patient capital, especially in a place like the US. So a lot of money is going into passively managed mutual funds instead of actively managed ones. And there's some evidence that these funds, these passively managed ones, are actually more patient than actively managed ones. So that's something we're continuing to think about. It's unclear that ESG investing on its own will shift firm preferences. There is some thought that if investors sort of screen for ESG indicators, that this may shift the needle on climate. It's unclear that'll be the case because this doesn't really change the intertemporal trade-off sort of dimension. It's still, if these funds are still threatening to dump stock, if firms don't hit quarterly profit expectations, then it still is that myopic pressure on firm managers. And lastly, the work implies a complementary mechanism that can explain cross-national variation because ownership structure varies quite dramatically across countries. Therefore, firms' preferences towards climate change will vary quite dramatically. And therefore, that should shape the politics quite differently in different countries and lead to different levels of policy stringency. So in terms of next steps, the first is we're thinking of a way to develop our own original dependent variable of measuring firm level climate policy preferences. What we want to do when we're applying for funding to do a survey, a firm level survey. We also plan to look at public communications by companies and other lobbying data to try to triangulate and pin down companies' preferences. In that survey, we also want to ask about time horizons, again, to develop another measure of time horizons. And then lastly, with ownership data, we want to separate out active versus passive investment managers. As I mentioned, right now, those are lumped together, but we think they're actually quite different theoretical expectations, so we want to separate those out. So with that, I'll end. Thanks very much for your attention and looking forward to your thoughts and comments.